Welcome, curious minds. Today, we're demystifying a cornerstone of financial well-being, investing. At its heart, investment is a commitment of resources into something expected to gain value over time. If those resources are money, then it's about committing cash now to receive more cash later. Think of it like planting a seed. You put a little in, hoping it grows into something much larger, earning returns through interest, rent, dividends, or price increases. From a broader perspective, investing is to tailor the pattern of expenditure and receipt of resources to optimize the desirable patterns of these flows. When we talk about money, the net amount received in a period is called cash flow. Over multiple periods, it's a cash flow stream. The goal is simple: arrange your financial inflows and outflows to maximize your monetary benefits over time. In finance, the fundamental purpose of investing is to generate a return on the invested asset. This return isn't just one thing. It can be a capital gain, which is a profit when you sell an investment for more than you paid. Or, if you haven't sold it yet, it's unrealized capital appreciation. Unfortunately, it can also be a capital loss. But that's not all. There are other ways to earn returns. Beyond capital gains, your investments can provide periodic income. This could be in the form of dividends from stocks, interest payments from bonds, or rental income if you invest in real estate. And if you're dealing with international investments, even changes in foreign currency exchange rates can lead to currency gains or losses. So, returns come in many forms, each contributing to your overall wealth. Now, for a crucial concept, investors generally expect higher returns from riskier investments. This is a core principle. When you make a low-risk investment, the return is also typically low. Conversely, a high-risk investment comes with the chance of significant gains, but also the chance of significant losses. It's a fundamental trade-off that every investor must understand and navigate. Given the risk-reward spectrum, how do you protect yourself? The answer, particularly for novices, is diversify their portfolio. Diversification is like not putting all your eggs in one basket. It has the statistical effect of reducing overall risk. By spreading your investments across various types and sectors, you cushion the blow if one particular investment doesn't perform well. Before you even consider which investment types are best for you, there are two crucial first steps. First, you'll need a brokerage account. This is like your bank account for investments, allowing you to buy and sell. Second, and often overlooked by new investors, is to build your emergency fund first. While some suggest 3 to 6 months cushion, aiming for at least $1,000 for emergencies is a smart start. The world of investments can seem vast, but it's helpful to think of them falling into 3 main categories: equity, fixed income, and cash. We'll explore each of these in depth. Additionally, we'll touch on alternative investments like real estate, which can play a vital role in enhancing your portfolio's risk-adjusted returns by spreading risk across different asset types. Understanding these categories is your first step to informed decision-making. Let's dive into equity, starting with arguably the most well-known investment, stocks. When you buy a stock, you're essentially buying a small piece of ownership in a company. This makes you a shareholder. As the company grows and becomes more profitable, the value of your share can increase, which is how you make a capital gain. Legendary investor Warren Buffett calls investing in U.S. stocks a bet on American business, a bet that has often paid off over centuries. How do stocks make money for you? Primarily through 2 ways: capital appreciation and dividends. Capital appreciation happens when the stock's price goes up, and you sell it for a profit. Dividends are a portion of the company's earnings that are paid out to shareholders, usually on a regular basis. Not all stocks pay dividends, but they represent a periodic income stream for many investors. Investing in stocks offers the potential for significant growth, but also comes with volatility. Next up, fixed income investments, with bonds being the prime example. Unlike stocks, bonds represent a loan you make to a company or a government. In return for your loan, they promise to pay you regular interest payments over a set period and then return your original principal at maturity. Financial advisors often suggest bonds can help you stay there, meaning preserve wealth, once you've built it through growth investments. There are three main kinds of bonds you'll encounter. Corporate bonds are issued by companies to raise capital. Municipal bonds are issued by state and local governments to fund public projects. And finally, government bonds or U.S. Treasuries are issued by the federal government, considered among the safest investments due to the backing of the U.S. government. Each type carries different levels of risk and offers varying interest rates. While generally less volatile than stocks, bonds aren't entirely risk-free. The primary concern is credit risk, which is the risk that the issuer might default on their payments. This risk varies significantly. For example, investment-grade bonds are less risky than high-yield bonds, and government bonds tend to have lower credit risk than corporate bonds. Credit ratings, like those from agencies, help investors gauge this risk. Lower ratings signal higher risk, potentially even tied to risks in the company's stocks. Investors measure credit risk using indicators like credit ratings, credit spreads, default rates, and recovery rates. To manage this risk, strategies include diversification, spreading your bond investments across different issuers, and credit analysis, thoroughly evaluating an issuer's financial health. Understanding bond ratings not only helps with your fixed income holdings but can also signal risks tied to the companies behind certain stocks, offering a broader market insight. The third main category is cash solutions. These are typically the safest and most liquid investments, offering easy access to your money. Examples include high-yield cash accounts, money market accounts, and certificates of deposit, or CDs. While they offer stability and low risk, their returns are generally modest, often just keeping pace with or slightly above inflation. They're essential for an emergency fund and for money you need in the short term. You might wonder about the difference between bonds and CDs, as both involve lending money for interest. Let's compare. Bonds are generally more complex, can be traded on secondary markets, and their value can fluctuate. CDs, on the other hand, are typically less flexible. You commit money for a fixed term to a bank and receive a fixed interest rate, often with penalties for early withdrawal. They are generally simpler and federally insured, making them very low risk. Now, let's explore pooled investments, which are fantastic for diversification and professional management. A mutual fund is a type of collective investment scheme where money from many investors is pooled together. A professional fund manager then uses this pool to buy a diversified portfolio of stocks, bonds, or other assets, making the investment decisions for you. The biggest difference from ETFs is that mutual funds only price their shares once a day and aren't as liquid, meaning you can only buy or sell at the end of the trading day. Another popular pooled investment is the exchange-traded fund, or ETF. ETFs are similar to mutual funds in that they pool investors' money to buy a portfolio of various investments. However, the key distinction is that ETFs trade on major stock exchanges, just like individual stocks. This means you can buy or sell shares whenever the stock market is open, offering greater flexibility and liquidity throughout the trading day. They often come with low expense ratios. Let's highlight the core differences between these two popular pooled investment types. Both pool money and offer diversification. However, ETFs trade continuously on exchanges, providing intraday liquidity, while mutual funds are priced once daily after the market closes, making them less liquid. ETFs often have lower expense ratios and typically don't have minimum purchase amounts, unlike some mutual funds. For new investors, either can be a great way to start diversifying without needing to select individual stocks. Within ETFs and mutual funds, index funds are a fantastic option for broad market exposure. An index fund aims to track a specific market index, like the S&P 500 index fund. If you invest in an S&P 500 fund, your money is automatically spread out among the 500 companies that make up the index. This means if any one company performs poorly, your overall investment is buffered. Nasdaq 100 index funds are another popular choice, known for their focus on large, non-financial companies listed on the Nasdaq stock market. A key advantage of many index funds, especially ETFs that track indexes like the Nasdaq 100, is their low expense ratio. This means the fees you pay to the fund manager are minimal, which can significantly enhance your long-term returns. Most brokers allow you to trade ETFs without a commission, further reducing your costs. They offer a cheap, efficient way to own a diversified basket of companies, making them highly recommended for many investors. Beyond traditional stocks, bonds, and cash, alternative investments can offer unique benefits. Real estate is a prime example. Investing in real estate can provide returns through rental income and capital appreciation if the property value increases. A significant advantage is that adding real estate to your portfolio can actually improve your risk-adjusted return by spreading risk across asset types that often behave differently than stocks or bonds. You can invest directly as a landlord, or indirectly through REITs or funds. The realm of alternative investments also includes commodities and crypto. Commodities, like gold, oil, or agricultural products, can offer diversification as their prices are often influenced by different factors than financial assets. Crypto, or cryptocurrencies like Bitcoin, are a newer and highly volatile asset class. While they offer potential for high returns, they also come with significant risk. The research notes crypto as an alternative asset, highlighting its non-traditional nature. For more advanced investors, options are another type of investment mentioned in our research. Options are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a certain date. They are complex financial instruments often used for speculation or hedging existing investments. Options can offer significant leverage but also carry substantial risk and are generally not recommended for beginners. While not an investment type itself, an IRA, or individual retirement account, is an investment vehicle. It's a special type of account that holds your investments and offers tax advantages to help you save for retirement. You can fill an IRA with many of the investment types we've discussed: stocks, bonds, mutual funds, and ETFs. Withdrawals before retirement may incur penalties, so it's designed for long-term savings. Understanding your tax considerations for different investment types is essential to maximizing returns. Deciding how to invest ultimately depends on your risk tolerance, time horizon, and financial goals. There's no single best investment for everyone. Are you saving for a down payment in 2 years, or retirement in 30? Your goals will dictate whether you prioritize low risk, stable growth, or higher risk, aggressive growth. A financial advisor can help you find the right type of financial investment for your specific needs and goals. To make informed decisions, investors use investment analysis. This is a broad term for evaluating financial markets and investment opportunities. It helps you gauge whether the possible reward from an investment justifies its risks. There are several types of analysis, from looking at individual assets to assessing your entire portfolio. Understanding these methods is key to maximizing your income or profits. One of the two main types of investment analysis is fundamental analysis. This method involves analyzing the financial health and performance of a company or investment. Fundamentally, you're looking at a company's financial statements, management, industry position, and future prospects. It helps investors assess a company's financial soundness, future business endeavors, and dividend yield potential to find stocks with significant growth potential that might be undervalued by the market. The other main type of investment analysis is technical analysis. Instead of focusing on a company's intrinsic value, technical analysis helps search for stocks with significant potential for growth whose intrinsic value might have been negatively mispriced by the market. This method involves studying past market data, primarily price and volume charts, to identify patterns and predict future price movements. It assumes that all known fundamentals are already reflected in the stock's price. Beyond individual investments, portfolio analysis is crucial. When performing this, an investor selects and evaluates a single asset in relation to how they complement other investments in the portfolio. It's about ensuring your investments work together. This may also include performing a stress test to analyze how your entire portfolio might perform under adverse market conditions, helping you prepare for potential downturns and optimize your overall risk-adjusted returns. An often overlooked aspect, but essential to maximizing your returns, is understanding tax considerations for different investment types. How your capital gains, dividends, or interest income are taxed can significantly impact your net profits. For instance, some investments held in retirement accounts like IRAs offer tax-deferred or tax-free growth. Always consider the tax implications before making investment decisions to ensure you're keeping as much of your hard-earned money as possible. For those feeling overwhelmed, a financial advisor can be an invaluable resource. They can help you define your financial goals, understand your risk tolerance, and navigate the myriad of investment options. A good advisor will help you find the right type of financial investment for your specific needs and goals, providing personalized guidance to help you build wealth smart ways. They can also assist with portfolio construction and ongoing adjustments. In essence, investing means putting your money to work so you can earn more over time. It's an active process of allocating resources, typically money, with the expectation of generating income or profit. Whether through capital gains, dividends, interest, or rent, the goal remains the same: to grow your wealth. Understanding the different types is your first step to making informed choices and setting your money on a path to growth. As we've explored, there isn't one single best investment. What's best is entirely dependent on your individual circumstances. Your risk tolerance, how comfortable you are with potential losses, your time horizon, how long you plan to invest, and your financial goals, what you hope to achieve, all play a critical role. A diversified mix that balances income, safety, and growth potential is often a smart move. Let's quickly recap the main investment categories we've covered: equity, primarily stocks, representing ownership and potential for capital appreciation and dividends. Fixed income, mainly bonds, representing loans that pay interest. And cash solutions, offering stability and liquidity, like high-yield accounts and CDs. Each category plays a distinct role in a well-rounded financial plan. We also delved into the efficiency of pooled investments. Mutual funds offer professional management and diversification, with daily pricing. ETFs provide similar benefits but trade like stocks on exchanges throughout the day. Both are excellent ways to gain broad market exposure, especially through index funds that track benchmarks like the S&P 500, offering diversification across many companies with relatively low fees. Then we touched upon alternative investments such as real estate, which can significantly boost risk-adjusted returns through rental income and appreciation, and briefly mentioned commodities and crypto. Finally, we looked at investment vehicles like IRAs, which are tax-advantaged accounts to hold your investments for long-term goals like retirement. These diversify your approach beyond traditional asset classes. Ultimately, becoming a successful investor isn't about finding a secret formula, it's about making informed choices. It's understanding the definitions, comparing the trade-offs, and aligning your investments with your personal financial journey. Remember, the journey begins with solid research, a clear understanding of risk, and a commitment to diversification. Your financial future is a garden, plant your seeds wisely.